Today we're going to start with some general property and casualty terms and concepts. Very, very important to get your mind wrapped around the verbiage that is used in this industry, because every industry does have its own terminology. It will help you tremendously for your exam. First thing that we're going to start with is the differences and the similarities between property versus casualty insurance. First of all, remember, any type of insurance, the product, the finished policy that you get is actually a contract, okay? On the property side, it's considered to be a two-party contract between the insurer, which is the insurance company, and the insured, that is the person who is covered or has the protection of the policy. And a property policy covers the losses to your possessions or your assets, your automobile, your home, your possessions or stuff in your house from your stereos, your TVs, your computers, all of those kinds of things can all be covered through property coverage. Then there's casualty or liability coverages. Now, that's always third party. There's three people involved in this contract. Again, the insurer, the insurance company, the insured, the person who has the policy or is the owner of the policy, but then the third party, the person who has perhaps been injured when they came onto your property. You want to take care of them. They have been hurt in your house or on your land. So third party contract, the policy pays the proceeds to the third party, the injured party who came onto your property and was hurt. Legal liability is covered for injuries or the damages to others. That's always the thing to remember on exam questions. You might even want to just kind of put that at the end. Whenever you hear of casualty/liability coverage, it's liability to others. Remember, they're that third party, the persons who came into your business or came into your home and were hurt or injured or their possessions were damaged while they were on your property. Okay? Let's discuss some terms that are typically used in property and casualty coverages. First of all, you have the word accident versus occurrence. They pretty much mean the same thing, but the accident is the actual event where someone is injured, okay? Versus the occurrence, it's a very similar thing. When did the occurrence happen that causes the loss of either property or injury to someone else, okay? Then you have direct losses and you have indirect losses. For example, you have a homeowner's policy and your house burns to the ground. Fire is one of the covered perils on the policy, so that means as long as the policy was in good standing at the time of the loss, they would cover the house based on the limits of the policy. That's a direct loss. You have completely lost the place that you live in. It's burned to the ground. That's a direct loss that is covered. Now, an indirect loss, if you connect it to the same situation, you have lost your home. You've lost your home to a fire. Where do you go? You have to have a roof over your head. You've got your family to think of. So you're going to end up more than likely, maybe some kind relatives, and after a while you might end up having to go into a hotel for a while the house is rebuilt. That cost, that extra money that's now out of pocket to you because you have that indirect loss of the roof over your head is also oftentimes covered by the policies, but it's an indirect loss because the first thing that had to happen was the direct loss, which was the complete destruction of your home by fire, which then causes you to have additional out-of-pocket expenses, such as maybe extra meals out and maybe hotel expenses and things like that. Let's talk about named perils versus open peril policies. With a named peril policy, the peril, which by the way, is a cause of a loss. What caused you to lose your home, for example, fire, lightning, internal explosion. Those are three very typical named perils on, for example, a homeowner's policy or a dwelling policy. Unless that your house was destroyed by one of those three, If it's anything but those three, there would be no coverage. It's very specifically, so it's very limited, it's very restricted to the specified named perils that the policy covers. Now, on an open peril policy, it will cover anything that causes the loss unless it is clearly spelled out in the exclusion section of the policy, which usually is at the back end of a policy. So if you have an open peril policy, and these are usually the more high-end types of coverages, for example, you would go to the exclusion section and look and see, okay, well, it says fire. Fire is not excluded, so that means, yep, for sure, it's going to be covered. And any other, things that could have happened to have you lose your home. But open peril, you always look at the exclusions, and so that means, here's a kind of a connect the dots kind of thing for you. What type of policy has the biggest exclusion section? That answer would be an open peril policy, because they have to specifically exclude every single incident or item that would not be covered, because if it isn't spelled out in the exclusions, they would have to cover the loss. Okay, so that's the difference between specific or open peril. Let's talk about blanket versus specific coverages. Specific is exactly that. You know exactly what is covered. For example, on your personal auto policy, it's your personal auto, right? Or your homeowners, it's your residence premises. It's where you live. It's the roof over your head. That's specific coverage. Blanket is a little bit different. Oftentimes, insurance agencies, for example, will cover their agents with errors and omissions insurance, which is actually a type of casualty insurance, and they may have what is called a blanket policy for the agency. So anytime a new agent comes on board, they're added onto that policy, and if somebody leaves, that person's name is removed. So it covers a group of people, if you will. It's blanket coverage for all of the commission-generating agents, for example, in an agency. Blanket versus specific, okay? And then the terms vacancy and nonoccupancy. They are different. Vacancy means you have none of your possessions. The rooms are empty. You've left nothing in the house, the dwelling, the structure at all. Plus, you're not there. No people, no possessions. That's vacancy, okay? Now, nonoccupancy, your stuff is still there, but you're not. Think about this. You're on spring break or you're going on vacation. You don't take all the stuff out of your house while you're gone, right? Your house is there. You're just not there for a week or 10 days or however long your vacation or holiday is. That is unoccupied. You're coming back. You're just temporarily gone. But vacancy is where the policies get a little bit more serious, because you now have an empty building. You're not coming back to it. You've taken all your possessions out of it, and it is vacant. The thing to remember about vacancy is most of the policies are going to read that if that building, that home, that dwelling is vacant for more than 60 consecutive days, your policy will cover nothing if something happens to the building. Okay, so 60 consecutive days of vacancy will void out your contract. So you always have to watch that number and be aware of that.
Named peril or open peril. When we purchase a policy with an insurance company, we are offered either a named peril policy or an open peril policy. Named peril lists specific covered perils. There's no coverages for unlisted perils. I like to call named peril only this. Only this is covered. If you have a named peril policy, it actually gives you essentially a bullet-pointed list of things that are covered. So, for instance, on a DP1 policy, you are covered for fire, lightning, and internal explosion. It's a named peril policy. I know exactly what kind of losses I am covered for. If it's not listed in my policy, I do not have coverage for it. An open peril policy is the opposite. It insures against any risk of loss not specifically excluded. Sometimes we use the term all risks for open peril. I like to call open peril anything but this. So when we purchase a policy with open peril, it does not list what we're covered for. it lists what we're not covered for. So anything other than what's listed will be covered. So open peril, anything but this. Named peril is only this is covered. Direct versus indirect loss. Direct losses are known as the direct physical damage to buildings or personal property, and it includes other damages where the insured peril is the proximate cause of loss. So direct damage is the actual thing that caused the loss. So a fire, for instance, would be the direct damage. Our house is burning down, it's on fire. When the fire department comes in to put out that fire, they're going to be spraying the house down with water. Now, there may be some property at the house that was not at risk or that was not burnt because they were able to put out the fire quickly, but now that property is soaking wet because the fire department was putting out the fire. So direct loss would be all of that situation, the fire itself, as well as the water damage to those items is now covered because it was done because of the fire. Direct loss, physical damage, is to the actual building itself, and then anything that ensues because of that direct loss. So a house catches on fire, the firemen apply water to put out the fire. So damage from both the fire and the water will be covered under the peril of fire. Normally, water damage is not covered at all. Outside water coming into a house is not covered. But when that outside water is coming into the house because they're trying to put out the fire, then it would be covered. Indirect loss is an economic loss as a consequence of the direct loss. The indirect losses are things that happen because the main thing happened. So, for instance, in the case of that fire, if an insured's house burned down in a fire and they had tenants who were renting out that house, those tenants cannot live in the burned out house anymore. The tenants are going to have to leave and go somewhere else. Well, you cannot collect rent from people who are not living in your house. So you are now missing out on rent. So the actual loss was the fire, but now you have a loss to your profit and to your income because you're no longer able to collect rent. This would be known as an indirect loss. The indirect loss coverage usually is added to property policies to make sure that after a direct loss happens, such as a fire, that you can make up what you're missing, such as missed out on rent. Another form of indirect loss, if you are in a car crash, you crash your car when you were on your way to work. Now you have to go to the hospital. You have to drop off your car to a repair shop. Maybe you miss work due to your injuries. Those are all indirect losses, things that would not have occurred unless the actual accident happened. So the direct loss would be the actual car accident itself. The indirect losses would be the time and money that was lost because of the accident. I'm not able to go to work because of the accident. I have to pay a hospital bill because of an accident. Those are all indirect losses.
Let's talk about types of hazards. There's actually three. There's physical, there's moral, and there's morale. This is one of the situations in the exam. You have to read the questions carefully because you're going to be nervous. So the word moral is M-O-R-A-L. The word morale just has an E on the end. It's M-O-R-A-L-E. And under the stress of the test, you might misread one or the other of those words. So slow down. Make sure you are reading the right word so you're choosing the correct answer. Okay? Let's look first at a physical hazard. A physical hazard is a condition that causes you to have an increased chance of a loss. Like, for example, you have a gas pilot light on your furnace, right? And you have been working on maybe a staining project down in the basement in your workshop, and you have a bunch of oily rags, linseed oil, all that kind of stuff, highly flammable. You know, these rags are soaked in it, and you've set them down right next on the floor next to the furnace where the pilot light is. That's a physical hazard that could cause a fire. Another example of a physical hazard is you've got very light, filmy curtains on windows. You've got the windows open, beautiful spring breeze coming through, and you light a candle just to set the mood, and it's just wonderful. And that light curtain just blows right across that flame of that candle, and it goes up in a huge bursts a flame, and starts the house on fire. That's a physical hazard. Okay, so be very careful about where you're putting things. Another example, in the fall, you happen to park your car on a pile of old, dead, dry leaves that, they kind of build up in the curbs sometimes. That can be very dangerous because the underside of a car, the exhaust system gets very hot. And if you're parked over a pile of those dry, crispy leaves, again, could start a fire. Physical hazards. Then you have moral hazards. It's a dishonest predisposition of the insured that is going to increase the chances of loss. For example, do you think you might have some losses if you wrote a policy, a homeowner's policy, for someone who's already been convicted of committing arson, meaning deliberately setting fires? That person has shown a predisposition for an illegal act that causes losses, so that would be a moral hazard, okay? And then you have morale. That's more of the mindset or the attitude of the person. They're careless to the point they just don't give a darn about anything. I know I've got an electrical short in the wiring. I'm not going to fix it. I've got insurance. It'll take care of it. They just are not mindful, careful homeowners because actually part of the contract reads that the insured is supposed to take care of and maintain the property. So they're not living up to that expectation because they present a morale hazard.
Blanket versus specific. When you purchase a policy, you can either have a blanket policy or a specific policy. A blanket policy is a single property policy with one total amount of coverage. Coverage for multiple classes of property at one location or more classes of property at multiple locations. With a blanket policy, I like to describe it as this. Imagine that you have a bunch of jewelry and it's all laid out on the table. You take a blanket and you lay it on top of the jewelry. Anything under the blanket is covered, but I don't know directly that there is exactly a 14-karat princess cut diamond ring, and I don't know that there is a 14-inch long gold chain necklace. All I know is that it is under the blanket and therefore it is covered. If I were to choose a specific policy, which is a specific kind or unit of property for a specific amount of insurance, I do need to know the names. I need to know that it is a 14-karat gold princess cut diamond. So blanket says we will cover anything under the blanket for a dollar amount, whatever you select, and you don't need to know the name of it because it's under the blanket. It's covered. I can't see it directly, but because it's under the blanket, it's covered. Specific insurance says exactly this is covered for only this dollar amount. It's going to depend on your needs as to whether you have a blanket policy or a specific policy, and what type of insurance you want for those items. Blanket is usually used for smaller dollar value jewelry items, and specific is going to be used for more expensive jewelry items. But this can apply to anything. So when we say multiple classes, a class could be jewelry, it could be furs, it could be musical instruments. So whatever it is that you're covering, you're either going to choose blanket, where it's under the blanket, I don't need to know the specific name of it, or you're going to choose specific, where I know exactly what that item is. Insureds. On a policy, we have different people who are insured on the policy, and not necessarily everyone is named on a policy, even though they may be an insured, which is why we have things like named insured, who is the actual individual whose name appears on the policy's declaration. So whoever purchases the policy, the homeowner, they're going to be the named insured. Their name is going to appear first on the declarations. Then we have first named insured. Now, first named insured is the individual whose name appears first on the policy declarations, and the first named insured is required to perform certain duties that include paying the premium and giving prompt notice of a claim to the insurer in the event of a loss. The first named insured generally often is for commercial policies. When a business has a policy, the insurance company does not call the customer service number and talk to any representative who is there. There's going to be a specific person that they talk to about the policy that that business has. And so that's going to be the first named insured. So on a commercial policy, the first named insured is very important. This is the primary contact that the insurance company has with the business in whom they are insuring. Additional insureds are individuals and businesses that are not named as insureds on the declaration page, but are protected by the policy, usually in regard to a specific interest. These are usually are added to the policy by endorsement. Additional insureds are going to be things like a mortgage company or a lien holder on a car. If we have a house and it burns down and the insurance company rebuilds that house, or if we decide not to rebuild, the insurance company doesn't owe the insured money, they may owe the mortgage company money. So they need to know who is covered on this policy in terms of who's going to be receiving the payment. When we crash our car and it is totaled, the insurance company doesn't send us a check if we have a lien on it. They have to pay off the car from the lien company. So the lien holder and the mortgage company are listed as additional insureds. They're not necessarily named on the declaration, but they are covered on the policy to ensure that the correct people get paid off on the losses that we have, whether it's home or auto. Binder. A binder is a temporary agreement issued by an agent or insurer providing temporary coverage until a policy can be issued. Binders are most often used for auto insurance. When we go to a car dealership and we purchase a car, the dealership wants us to know that we have insurance. But all insurance policies begin and end at 12:01 a.m. If I purchase a car at 6 p.m., even if I call the insurance company and issue a policy, it's not going to be effective until 12:01 a.m. later that night. The binder is what is given to us when we're sitting at the car dealership to let the dealership know that we will indeed be covered even though our official policy doesn't start until 12:01 a.m. The binders can be written, but they can also be an oral confirmation over the phone. The binders will expire when the policy is issued or after a specified number of days, and every state will have their own requirements for that. The effective date is the same as the date when the binder was issued, and if the policy is declined, binders expire on the date after receipt of the notice of cancellation. So a binder is just a temporary way for us to make sure that we have coverage between the time we acquire the property, such as a car, until the policy officially starts. And as soon as that policy starts at 12:01 a.m., the binder essentially expires. It was only good to make sure that we can drive off the lot in our brand new car.
Let's talk about some additional terminology that is very important for your exam. The first one is insurable interest. Insurable interest means you have to have a valid reason for writing insurance on, say, that house. Well, it's your home, it's your residence premises, it's where you live. That is definitely insurable interest that you would want to protect where you live, right? Well, also on property and casualty, these types of policies, you prove insurable interest at the time a claim is filed, not when you take out the policy, but when you actually have a loss and you're filing a claim. Okay, so that's a little bit different from some other insurances, okay? The term underwriting, that is what the underwriters do at the home office of the insurance companies. They review the information on the application, they review your agent's reports, they may order some consumer investigative reports, all different kinds of things to gather information in order to determine what risk you present to the company and if you are insurable or not. If you present too much risk, they can either charge you more or they could just totally decline covering you at all. That is what the underwriting department does, is choose that risk selection. They put you through that process. And then the rate, that is actually the cost of your coverage, the cost of the insurance, what it will cost you based on how you're rated. They go together, okay? Then you have a loss ratio. Very simple. I know if you're like me, you see ratios and you think, oh, but it's really not hard to figure out. Loss ratios, you look at incurred loss, you're an insured and your house burns down. That's a loss that you've experienced and that your insurance company is covering, right? And of course, when an insurance company pays out a claim, that's a loss to the insurance company, right? Because they're taking that money out of their pocket and, paying you because they want it to take on the risk of covering you, correct? So you take the incurred losses and any adjusting expenses that might be present, and you divide that by the premium that's been paid into the policy, and that gives you your loss ratio. And as an agent, you will be judged by this ratio. Agents are always looked at. They expect your clients to have some claims. I mean, it happens, right? But that's why people buy insurance, correct? Well, they expect your clients to have claims, but they have parameters. They will have decided that the company standard is this, or here's the benchmark. And if you're kind of below or right at that benchmark or just slightly above, that's pretty much where the insurance company would want you to be. But if your loss ratio is supposed to be down here and it's way up here, that means possibly you might need to do some retraining on how to select the proper people to bring in as clients and to present them to the underwriting department and things like that. So it could be a training issue. It could just be that you've had a run of bad luck, but they do kind of hold that as a benchmark for you as an agent. They use the loss ratio. And then there's a term, you'll see it a lot on the exam. It's called subrogation. And what happens, let's say, for example, you are involved in a hit and run accident. Somebody hits you and they take off. So there's nobody to pay for your car but you, right? That was damaged in the accident. So what do? You file the claim with your insurance company. They come out and they say, well, your car is totaled. We're going to write you a check for the value of the car, and then you can go out and get another car. And this is all on your policy, right? Well, when you accept the claim check from your insurance company, you are in essence subrogating or turning over your right to go and find that party who harmed you, who caused your loss, and you're giving it to the insurance company. You subrogate the right over to go and find these people and sue them for the losses that you incurred. And the insurance company will then do that. And if they can find the people, they will try to get some type of compensation back from the person who injured you, because the insurance companies basically paid for it out of their pocket, even though it wasn't your fault. So that is subrogation. You accept that claim, settlement check, then you give the right to sue that third party to your insurance company. There's a term called loss valuation. There are a number of different ways losses can be determined, and that's what we're going to talk about next. Probably the most popular, the most preferred method of loss valuation is called replacement cost. If you lose something, let's say, your house burns down. You would love to have your house replaced at replacement cost, which means that the cost to replace it with, and here's the terminology, with like, kind, and quality at today's prices. What it would cost to restore your home to what it was at the time you had that fire, let's say. That's replacement cost. At whatever the prices are today, they put it back just like it was. Like, kind, and like quality, meaning exactly the same kind of drywall and timbering and flooring and all of that. Okay, so that's replacement costs. The second one is actual cash value. Actual cash value is replacement cost, but then they depreciate it because that house was used, right? You lived in it for a while. So if you have actual cash value as the method that's going to be used, they're going to figure out what the replacement cost would be, but then they're going to depreciate it down for every year that you had the house, so you will receive a lesser amount. Okay? A lot of times on policies also, if a policy typically offers actual cash value, they will let you upgrade to replacement cost. What do you think that's going to do to the premium? It's going to increase the premium because it costs the insurance company more to replace like, kind, and quality replacement costs than it does to take that replacement cost and then put depreciation against it for a lesser number. So that's a concept you need to make sure you understand, okay? Replacement cost and actual cash value. Then there's something called functional replacement. It's the cost to replace with modern, less expensive construction or materials. There's a fairly specific use for this kind of method. And let's say you have a historic home, some home that's on the National Historic Register even. There's no way that you could replace that gorgeous carved mahogany mantelpiece that you had in the living room. You had a fire and it's completely destroyed, right? Possibly the wood might not even, the exact kind of wood might not be available anymore, or the cost to obtain it would be so astronomical that it's just impossible. And typically you just can't find the same kind of materials that were used, or the craftsmanship that went into the carving of that mantle, for example. So they would use a functional replacement, meaning that they would replace using modern, less expensive materials, and hopefully it ends up kind of sort of looking like what the original did. Now, are you as a homeowner going to be happy with that? You might not be. But if that's the way the contract is written and the insurance company pays to the limits of the policy, what you could do is accept that payment, and then you would have to go out and try to find an antique mantle and pay the difference out of your own pocket. That's always an option with this kind of functional replacement, because many people, they choose to live in an older home because of the historic nature and the preservation, so they want to try to keep it as true to its original age or period when the house was built, up to the homeowner, okay? Then you have market value. That's basically, if you were to put your house on the market today, what do you think you could sell it for? Who would buy your house and what would they be willing to pay for it? That's market value, current market value. Then you have agreed value. That is a fair valuation based on the amount of insurance agreed upon. And what that means, oftentimes it's used, if you think artwork, things that, sometimes a certain piece of art will be very valuable today, and in 10 years its value has just dropped, or in 10 years its value has just soared. So artwork, sculpture, paintings, those things are hard to actually get your arms around what they really could be worth, and hopefully you never have a loss, but you want to insure against it in case you do. So what they usually do is use the agreed value. At the time the policy is taken out, they might bring in appraisers to say, okay, in your opinion, what do you feel this picture is worth? And everybody will agree to a set dollar amount that, okay, this is what we will pay in the event of a loss, okay? Now, it might be worth a lot more, and then you might get into a bit of an arbitration kind of situation where you're going to have to, meet some kind of agreement for the payment you might accept. But basically, think of agreed value on something that is typically more difficult to value to start out with, and you agree upon at least that's a starting point should you have a claim on that thing, like a piece of art. And then you have the stated value. Another term for that is the limits of the policy. It's the dollar amount that your policy clearly states on the declaration pages that they will pay in the event of a loss. That's the limit or the stated amount. Okay? Those are the different loss valuation methods. Let's talk about the elements of negligence. First of all, there's the legal duty. Everybody has a duty to either act or not to act appropriately or inappropriately. It's a choice, right? You as a homeowner, you decide to not shovel your walks or clear the ice off of your driveway and your sidewalks, and somebody slips and falls and gets hurt on your property. You chose not to act. You chose not to do the right thing, right? Okay. Then there's the standard of care. A defendant used a standard of care that breached their legal duty. Again, using that icy sidewalk situation, the defendant decided, the homeowner made a conscious choice to not do what he knew he should have done, and that was clean those walks, okay? Proximate cause. Proximate cause is an unbroken chain of events that causes damage. Think of it this way. First of all, it rained, and then it sleeted, and then it snowed, and then the temperatures dropped, and then it froze overnight, and the next day, the homeowner didn't go out and clear the sidewalks, right? So all of those events that happened, the weather started raining, and then it turned to sleet, and then it turned to snow, and then the homeowner didn't go out and take care of it. All of those items together is the proximate cause or the connected events that caused the person to be injured on that property. Okay? Proximate cause. And then actual loss or damage, that is the actual injury or damage to either a person or their possessions. In the example I've been using here, the person fell and broke their leg. That was the damage that was caused by the homeowner not being responsible. There are basically two types of negligence. There's contributory and comparative, okay? With contributory negligence, the injured party must be completely free of fault. Okay. Any negligence on the part of the insured party that contributed to the injury will defeat the claim. Let's look at that again. Any negligence on the part of the injured party, the person who got hurt, did they do something neglectful and that's why they got hurt? If that's the case, then there wouldn't be a claim. But with comparative negligence, the fault is shared between the two parties, the person who was injured and, say, the homeowner, for example, in the example we've used here. Awards for damages are reduced by the percentage of negligence of each party. So they say in pretty much, every case under comparative negligence, what's the one thing the injured party could have done? Stayed home, right? Not walked on the icy sidewalk. So they have a little bit of responsibility for slipping on the ice, but still the homeowner is going to bear the brunt of that claim. Let's talk about the types of liability. And remember, it's always liability to other persons, not yourself, the insured, okay? Absolute liability. Obviously hazardous activities. The injured party doesn't need to prove that there was negligence. It is so apparent. For example, you live in a residential area. You keep a tiger as a pet. Some child in the neighborhood is bitten by a tiger. Who do they think is going to be responsible for that? You. You're the only person in the neighborhood who owns a pet tiger in their backyard, right? That is absolute negligence. There's no doubt in anybody's mind that your tiger did that damage. Okay. Then you have strict liability. That's product liability. Liable for defective parts, regardless of fault or negligence. If you create a widget and that widget hurts somebody because a piece malfunctions or whatever, you, the person who created that widget, is always going to have that strict product liability because it's a product you created, okay? And then you have vicarious. What a great word. Vicarious liability. It's actually based on Old English law where the masters were liable for the acts of their servants. Well, in this day and age, if you've got kids, they're kind of like built-in servants sometimes, hopefully, right? So basically, parents are liable for the acts of their children. Vicarious liability. Let's talk about the structure of property and casualty policies. They use continuity or uniformity in this industry. So if you look at two insurance companies' policies, they're going to follow the same order. It's much easier to understand, right? First of all, the very first page, very important, it's called the declarations page or the deck page or the deck sheet. It's always the first primary page of the policy, and everything important about that policy is going to be right on that first page. So it's what, who, and how much. Who's the insurance company? Who's the insured? What is being insured, like the address of the home, for example, and what are the limits? How much is the insurance company going to be responsible for paying should there be a loss? Okay. Then you have a whole section on definitions, terms that are used within the policy in order to make it more clear for the customers. You have an insuring agreement. The insuring agreement clearly spells out who has the promise to pay. Well, the insured promises to pay the insurance premium, right? And the insurance company promises to pay claims based on the limits of the policy. That's how it works. Then you have additional, or sometimes called supplementary coverages. There are additional amounts of coverage that can be added on for specific losses. Sometimes there's a charge for them, an extra charge, sometimes not. It depends what they are. So you want to make sure you get familiar with what you're selling. And then the conditions are going to be spelled out. It's the rules and the procedures under the policy. Like, for example, as a homeowner, one of your responsibilities under the policy is you are supposed to maintain the home in good order. Take care of it. If something breaks, fix it. That type of thing. Endorsements. Endorsements are add-ons or addendums that change a policy. So endorsements, even something, if you needed to change an insured or something like that, you would do it by endorsement, and it has to be agreed upon by the insurance company and the insured. There would be a form filled out, an addendum form. Both parties sign it, and you would get a copy as the insured to put it in the policy, knowing that, okay, now this person is a new insured person or something like that. That's an endorsement. They're always added on to the policy. Exclusions. Exclusions are always found at the end of the policy, and if something is excluded, it means there's never any coverage. One of the most important ones, or the most typically found on all policies, acts of war are never insured. If you lose your house due to an act of war, your policy is null and void. It will not pay because it is an exclusion. Common policy provisions. Appraisal or arbitration. They mean basically the same thing. If the two parties of the contract, the insurance company and the insured, can't agree on a claim being settled the right way or in the right amount, they can call up the appraisal system, and usually there's 3 appraisers come in. 2 of them will kind of review and do the research and kind of make a decision. The third one is there to settle any ties in the voting, and that third person, that third appraiser, is called an umpire. Think baseball and it'll help you remember it, okay? And then assignment, that's the transfer of rights or interests to someone else. You may have taken out the policy and now you're transferring the ownership of that policy to someone else, okay? That's assignment. Other insurance, it means you have other insurance policies, so multiple companies or at least multiple policies are going to share in covering whatever loss you experience. Loss settlement, that is the notice of claim and the proof of loss. The notice of claim, the insured calls the insurance company and says, my house burned down, and then they have to fill out a claim form and send that into the company. That completed claim form is the proof of loss of that house, right? The insurer provisions, they are things that the insurance company does. For example, liberalization. Liberalization is when an insurance company, at no cost to the insureds, and they have to give this little extra tweak, this extra feature, they have to give it to all of their policyholders at no charge. It's a win-win. They keep their customers, and you have better insurance. You got a little bit better tweak of some kind of coverage was made better. Why would an insurance company do that? Probably to stay competitive. Another competitor added a little tweak to their policy, so they liberalize, meaning they make their policy have better coverage as well. Subrogation, that is when you accept a claim from an insurance company and you waive your right to go out and find that third party that injured you, and you give that right to the insurance company to go out and try to sue the third party who caused you to have a loss, for example. And then salvage. When an insurance company totals your car and they give you that insurance claim check, that settlement check, the car, something has to be done to the car. Typically, the insurance company claims the salvage. They take the car that is now totaled and not drivable anymore, and they sell it for pieces and parts and try to recoup some of that money that they paid you in the claim. Did you know that as an insured, you can say, write me a smaller check, but I want to keep the car and I'm going to sell it for parts and keep the salvage money. The insured always has that opportunity to do that. Most people accept the claim check and let the insurance company sell it for pieces, parts. Okay? And then the third-party clauses. They are standard mortgages, loss payable, no benefit to bailees. Those are all the kinds of third-party situations that typically are not going to be covered in any extraordinary way. It's just kind of built into those third-party clauses within the contract.
The deductible is the dollar amount that the insured is going to pay for a loss. If we have a $10,000 loss, the insured is going to cover some of that via their deductible. Now, when we purchase our policy, we set our deductible $500 or $1,000, and we know that if we have a claim, and whether it's a car accident or a homeowner's claim, the auto owner or the homeowner is going to pay that deductible, and then the insurance company will take care of the loss after that amount up to the policy limits. The deductible is also there to make sure that the insured is not making small claims. So the deductible makes sure that the insured absorbs smaller losses and that the insurer covers larger losses. If I have a $1,000 deductible on my auto insurance policy and I get a nick in my car and I want to fix the paint, the goal is that I would take care of that myself without making a claim to the insurance company. So that $1,000 deductible is going to prevent me from making a claim for the nick in the paint, so that I take care of it myself and I don't put that burden onto the insurance company. The insurance company really wants to pay for large losses, a full out, damage to the car, totaling that car, really damaging that car, or a home, the kitchen fire has completely taken out that kitchen. If it's a small item, truly the homeowner or the auto owner should be taking care of that themselves, and the deductible kind of helps make sure that they do that. That any small losses that are close to the dollar amount of the deductible, they're taking care of on their own, and it's those large types of losses that we actually submit to the insurance company. Now, when we purchase our policies, when we select a high deductible, that means that we're saying we're willing to pay more of the loss. Our premium overall is going to be cheaper because it's balancing it out. The more I'm willing to pay during a claim, the less the insurance company has to pay during a claim. So they're going to give us a cheaper premium. So my monthly bill is going to be smaller if I have a high deductible. And the flip would be true. If I have a very low deductible, I'm going to pay a much larger amount each month to have that on my policy. Insurance to value and coinsurance. When we purchase a homeowner's policy, we should be covering that home for essentially what it's going to cost to rebuild that home. That is called insurance to value. Insurance to value provides a replacement cost settlement to the policy owner who carries adequate insurance. It is property insured to the exact dollar amount or percentage of its value and is usually found in homeowners' policies. So when we have a home and it's estimated that if that entire home were to burn down to the ground and the insurance company had to come in and rebuild it, insurance to value says that we'll have as much money as we need to rebuild that home from the ground up to similar like kind of quality as it was before. So insurance policies really do want you to carry the proper amount. If your house were to burn down and you don't have the proper amount, they're not going to be able to rebuild your home to what it was before, which is the whole purpose of insurance, to bring you back to where you were before the loss occurred. Now, coinsurance kicks in when somebody does not want to carry insurance to value. Coinsurance is a way to ensure that you are insuring to value. Coinsurance is the insured agrees to maintain a certain minimum amount of insurance on the property policy. There are instances and there are times where it makes sense for someone to carry less than what they think is needed to rebuild the home. Generally, contractors who own their own homes know that they can do many of the repairs themselves, and they know that they're not going to be relying on the insurance company to rebuild their house. People like that will normally ask for a lesser amount of insurance on their homeowners than what the insurance company is recommending, and that could make sense. But there are times where people ask to cover a home for a lot less than what the insurance company is suggesting needs to be provided on the home to make sure that they can rebuild the home from the ground up. When this happens, the insurance company essentially says, if you're going to be cheap, we're going to be cheap. When somebody wants to carry a lot less on their homeowners than what is required, the insurance company says, fine, if you want to carry a lot less than what you should be carrying, when we pay the claim, we're going to pay it a lot cheaper based on the fact that you decided to carry the home a lot cheaper. So when a person does not carry the correct insurance to value, an equation kicks in for the insurance company on how they're going to pay out their losses. The coinsurance equation says that they're going to divide insurance carried divided by insurance required times the loss will equal the payment. This is the equation the insurance company uses to say, you were cheap, we're going to be cheap. So if I had a home that the insurance company estimates would cost $100,000 to rebuild, and I decide to only carry $50,000 on that home, I'm basically only covering that home for half of what I should be covering. So if I were to have a claim, the insurance company is going to say, well, you paid such a smaller amount than what you should have. We're going to pay a much smaller amount on that claim as well. So they're going to say you carried $50,000. You should have carried $100,000. You had a $10,000 loss. We're going to solve that all out, and that is what we're actually going to pay on the claim. So it's a way of an insurance company paying a lot less on a claim because you decided as an insured to pay a lot less for the actual insurance that you have on the house. Primary versus excess coverage. A primary policy is a policy that is going to pay first up to the limits of the event of a covered loss. So we have an auto policy. Our auto policy is what's going to pay first. It's the primary policy on our car. An excess policy generally are going to be umbrella policies, and the umbrella policy is going to pay only after the primary policy has paid up to its limits. All other insurance must be exhausted before the policy will apply. So when we purchase an auto policy and we select liability limits, we're only allowed to get so much, maybe up to $500,000 for liability. If we are in a car accident and we injure someone and send them to the hospital and that bill is over $500,000, we are on the hook for that ourselves unless we have purchased an excess policy like an umbrella policy. The umbrella policy, though, is going to require that our auto policy pay out fully and completely before the umbrella can kick in and begin to pay some of the additional coverages or the additional injuries after the accident. Limits of liability. Not a trick question. How much will an insurance company pay on any policy? What is the maximum value that will be paid out on an auto insurance policy? The limits of liability. The limits of liability are the insurer's liability for payment as stated in an insurance policy. It is the maximum amount an insurer will pay for a particular loss. And it can be expressed in three different ways. It could be a single limit, split limit, or aggregate limit. It really depends on what type of policy we're looking at to determine if we're going to be using single, split. When we purchase a home policy, we normally have a single limit for our homeowners. So coverage A on the homeowners is for the house itself. We select $100,000 for rebuilding that home if it were to burn down to a ground. So that would be an example of a single limit, just one limit for the house. If the house were to burn down, that's how much money the insurance company will pay to rebuild that house. Split limits are more common on car insurance. We usually pick a bodily injury limit per person and a bodily injury limit total for accident. So Arizona has a state minimum of $15,000 per person, $30,000 per accident. So if we were to get into an accident and we were to hit two people, each person can only claim up to $15,000 and no more than $30,000 could be claimed for the entire accident. So single limit would be exactly one limit for the situation. Split limit could be separating bodily injury per person to the total accident itself. Aggregate limit is the limit on the policy that is the maximum an insurance company will pay after all claims. So if I have a car accident, I'm going to have $15,000 per person, $30,000 per accident. And I have that for this accident. I have that for an accident from a week from now or an accident in a month from now. I will always have the $1,530 until I hit the aggregate limit. The aggregate limit is when the insurance company says enough, that you have filed too many claims, you've collected the $1,530 essentially too many times, and now you have exceeded a limit and we will pay no more than what the aggregate limit is. The aggregate limit is usually a very large dollar amount. It would be rather difficult in a regular person to hit the aggregate limit, but essentially the aggregate limit is a cap. It is the most that the insurance company will ever pay for any one policy that is purchased. Cancellation versus non-renewal. There are two ways to end a policy. Cancellation is going to be the termination of an in-force insurance policy by either the insured or the insurer prior to the expiration date shown in the policy. So if we have a 6-month policy that goes from January until June, that policy is going to be in force for those 6 months. Cancellation would be ending it before the 6 months is up. So you might cancel it 3 months in or 4 months in. Whatever the time period is, cancellation is about ending a policy while it is supposed to be in force. Non-renewal is the termination of an insurance policy at its expiration date by not offering a continuation of the existing policy or a replacement policy. When we purchase an auto policy, we are usually under the assumption that we purchase it for 6 months. At the end of 6 months, a new one will automatically kick in, and we just continue that until the customer decides to switch companies or end the policy. There are some instances in which an insurance company would not want to keep doing that. If someone has made numerous claims, or if an insurance company no longer wants to cover in that area, they cannot stop the policy. An insurance company is not allowed to cancel a policy except for very strict reasons such as non-payment. So non-renewal tends to be the insurance company's only option when they want to end a policy with an insured. So they'll just end it at the end date. An insurance company cannot cancel it between your 6-month period. All they can do is wait till the end of the 6 months and then not offer you another one. There are exceptions to the rule. Obviously, like I said, if you do not pay your bill, they're obviously going to cancel it. But if there's any other reason that the insurance company does not want to have you as an insured anymore, their option generally is to non-renew you as opposed to canceling you. So canceling ends the policy while it's supposed to be active. Non-renewal just says, we're going to let the policy finish and then not offer you another one after that point. Vacancy versus non-occupancy. Technically speaking, the definition of vacancy is an insured structure in which no people have been living or working and no property has been stored, usually for 60 days. So for an example, you've put your house up for sale and you have already moved over to another house and you're living in the other house, and your first home is now sitting empty and for sale. No one is living in it. If this home is sitting empty for 60 days, on the 61st day, you begin to lose a lot of coverages that you previously may have had on the policy simply because it is sitting vacant. Now, non-occupancy is the insured structure in which no people have been living or working, but some property is stored. This would be an example of where the insured is on an extended vacation. So if I am going away for 2 weeks and I'm coming back, the house would be deemed as non-occupied as opposed to vacancy. Now, when you are taking the test, they very rarely talk about non-occupancy. They more focus on vacancy, and they really drill in the fact that it's 60 days. For insurance companies, even if there may be some property, it's very specific about what type of property. There's a very clear difference between I moved out and maybe I've left some stuff that I don't care about anymore in the house as I'm trying to sell it, and I left everything I own in my house and I have gone on vacation. So it's not fair to say that some property is still stored at the house and therefore it's not vacant. It truly means like property that you use to live with, that you daily use, that you daily have, not just some storage. So as soon as a house is sitting without people in it for 60 days, it is considered vacant, and the insurance company will limit the claims that they pay for that. It won't fully outright end all claims that you submit to the insurance company, but you will begin to lose a lot of coverages even if you are paying for them. So one of the coverages that you can lose at vacancy is vandalism and malicious mischief. You may have bought that coverage and you have that coverage on your policy, but on day 61 of the house being empty and you not living in it, that coverage will no longer be covered even if you are paying for it on the policy. So there's a very distinct difference between vacancy and unoccupancy. In terms of the test, really just put into your mind that 60 days is what will take a place from vacancy to unoccupancy. Now, there is a difference between the insured going on vacation for a long period of time or if it is a secondary residence. If you have a beach home and you're only there during the summer, obviously for 9 months out of the year, you're not in that home. As long as your policy is written and stated that this is a secondary residence and it notes how long you are there and or not there, it would still be considered non-occupied. But vacancy generally kicks in at 60 days if it's supposed to just be a regular house and there's no stipulation that it's a summer home or a winter home or whatever.